Hello, and welcome to our second quarter strategy review for 2022. We met via Zoom March 29th, and with me was Len Skeena, Vice President, CEO of the firm, Bob Toomey, Vice President, Director of Research, and our special guest, Mike Riggs, Senior ETF Market Strategist with State Street Investments. State Street is one of the ETFs that we use throughout our portfolios for our clients. One other thing that we discussed at the meeting was the fact that for the fourth time in the history of the firm, we did pull a trigger which was set at our previous quarter. That trigger dealt with the University of Michigan, and that trigger was if consumer confidence dropped below 65, we would take action. We did take action primarily to reduce volatility. Volatility became quite extreme because of the things that were happening in Ukraine. And therefore, we decided it was time to take action. And that action was fully reviewed as we go through this quarter's review. With that, I'd like to turn it over to Bob to discuss U.S. equities.
Thanks a lot, Stan. So as Stan just mentioned, I guess I would have to agree and describe the recent market conditions as being unsettled, but not crazy unsettled. Put it that way. The market, we did see a 15% correction in the March quarter. A 15%, that is about in line with the long-term average for market corrections, which occur on average about once every 13 or 14 months. And to some degree, we were overdue for a pullback. And this combination of factors, the war in Ukraine, concerns over inflation, and concerns over Fed policy, I think all came together to really create this turbulence that we saw in the first quarter. But as I've said before, and we've said before on these videos to you, that volatility is not only normal, but it's an essential ingredient to the higher returns that we benefit from as equity investors. With respect to the fundamentals on the outlook for stocks, I would point out that the economy continues to look strong. Employment is strong. We think that corporate profits are strong and will continue to remain reasonably strong going forward. And because consumer balance sheets continue to remain very strong, we expect continued good consumption on the part of consumers. Uncertainty will remain elevated as a result of the situation in the Ukraine. But as Stan mentioned, we did adjust our holdings following the trigger several weeks ago, which we think positions us better for what we expect will be continued volatility. The other thing I'd like to point out with respect to Federal Reserve policy is, there's a lot of hand-wringing and concerns that in Fed rate hike cycles, stocks cannot do well, and that is not true. History has shown, if you go over the last 10 Federal Reserve rate hike cycles since 1954, stocks have gone up on average about 21% on average during those rate hike cycles. So that is not a major concern to us at this point. I think the outlook generally, as I said, remains positive because of continued investor interest and demand for stocks. Stocks will continue to be vehicles for above average returns. And I think that that's going to continue to create demand for stocks, which should keep a positive tone and lift to the stock market going forward, albeit with somewhat elevated volatility. I would also add that we do not see a recession this year. You may be seeing a lot of talk about that in the news media. We don't see a recession happening this year because we continue to believe that the underlying economic fundamentals are good. And we think the Fed is going to be very transparent and cautious and deliberate in the way they conduct their monetary policy. And I think the last thing the Fed wants to do is, create the conditions that might put us into a recession. Overall, our equity strategy remains unchanged. And I would like to turn it over now to Len to talk about the international outlook.
Thank you, Bob. On the international front, not surprisingly, much of the discussion we had centered around what's going on with respect to the Ukraine war. That war and the subsequent sanctions that have been placed on Russia are significant headwinds for the international markets, as well as just the general uncertainty surrounding exactly how all of that is going to play out. It's caused us to underweight international more than we're underweighting any other equity area at this point. And it is also causing us to just kind of be a little bit more reluctant to get remotely aggressive in that area. We do look at it right now. We have increased our allocation to international from the low that we had in the last quarter, recognizing that some of the uncertainty has kind of played out at this point and markets have already reacted to it. But we do feel uneasy going overboard or even going to a full normal allocation at this time. And so with respect to the international area, we're not going to do that right now. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. Yes, REITs are actually the only area that we are currently overweight, and we continue to be overweight. And even through the trigger that we pulled a couple weeks ago, we continue to be overweight. Our reasoning being pretty simple, that real estate continues to be very, very positive. And of course, REITs do pay out 95%. They must pay out 95% of what they earn. So it also helps dividends and it increases the return on the portfolio. More specifically, the REITs themselves deal, of course, with the three large real estate investments. One, of course, being office buildings, two, of course, being large apartment buildings. And we feel that while these areas will continue to do well, we also are emphasizing, again, the apartment side. With the relaxation of restrictions for allowing landlords to raise rents, allowing landlords to kick out, if you will, people that aren't paying the rent, we feel that that particular area will probably do best in the real estate area. So again, we continue to be overweight in real estate and we continue to be very positive on the REIT investment. With that, I'd like to turn it back over to Len to talk about fixed income.
Thank you, Stan. The fixed income area is an interesting area at the time. The Fed is absolutely right now walking a tightrope. They want to raise interest rates, and several interest rate hikes have already been priced into the market. We believe that there may even be fewer interest rate hikes than have been priced in. But at this point, there are definitely several interest rate hikes that we can expect that the Fed is going to implement within the next several months. That is going to ultimately affect bond portfolios because bonds are interest rate sensitive. As interest rates go up, the value of bonds goes down, and that's typically affecting the longer end of the curve more than it affects the shorter end. We have positioned ourselves to overweight ourselves to the shorter and mid portion of the curve so as to take advantage of those rising rates and so as to try to avoid as much exposure on the long end. We've also introduced a new fund as a bond surrogate on the long end. It's not uncommon for us to historically use some form of utility stock as a bond surrogate, and we have done that. In this particular case, what we're looking at is a collection of stocks that are focused on energy infrastructure and that pay a yield that is about 4.5 times the rate that we would be getting from the long-term treasury portion of our long-term bond investment. We expect that this is going to both keep the portfolio hopefully less volatile or at least less sensitive to those interest rate hikes, while also adding some additional yield to the portfolio and allowing us to get some benefit on the fixed income. With that, I'd like to turn it over to Bob to talk about the changes in our holdings.
Thanks, Len. So my part on this is going to be pretty short because there was really only one change, which Len very, very aptly discussed. That was the introduction of the Alerian MLP. We did have quite a long discussion about that. The only thing that I would add there would, from the research side of it, would be that, you know, these are the companies that are held in this particular fund are absolutely essential to the operation of our energy infrastructure in the United States. These companies move oil and gas out of the production areas of the United States to major refineries and export centers. And I think that given the situation in Ukraine and the shunning of Russian oil, that the U.S. energy infrastructure is going to become increasingly important and a source of exports to particularly to Europe, which is going to be, I think, more dependent on the United States for natural gas. So we do see that as a good, not only a good income play, but as a good growth play as well. With respect to other key holdings, within the large cap area, we continue to hold the MOAT, which is the large cap wide moat ETF. Those are large companies that have strong financials and carry a buy rating by the Morningstar analysts. Though that fund has significantly outperformed the S&P 500 value sector over a long period of time, and we think it gives us some good exposure in the value area. Within the commodities, we're also enhancing our holding of the upstream global resource ETF with the SPDR metals and mining ETF. That has done very well for us. We continue to think that's a strong holding given the outlook for higher inflation, which we expect, and strong commodity prices. Other than that, within the fixed income area, we talked about the Alerian MLP. We're also holding the senior loan floating rate ETF and the short-term high yield ETF as ways to enhance income in the bond area in both the intermediate and short-term areas of the yield curve. So again, I just want to reiterate why we own some of those holdings and why we think they're important at this time. With that, I will turn it back to Stan for closing comments.
Closing comments this time are a little bit different in the sense that the meeting did reflect the fact that we were concerned about volatility. And although we are not negative, as Bob, I think, quite correctly pointed out on earnings, et cetera, we are still concerned about volatility. We did, in fact, as I said, pull a trigger middle of the month, and it was only the fourth time. And this time we discussed triggers because we don't necessarily want to. We're looking at things that could happen that we don't expect. And this time we set one trigger, which was really a positive trigger. Two, really. One of them was if the University of Michigan Consumer Confidence Index rose to 75, which would be 10% above where we set it before, then that would be a positive trigger. We also said that if sanctions were lifted on Russia at the end of the current problems, that would be an unexpected positive event. I think none of us really think that that's going to happen, to be honest. And the other one was actually a negative, and that was our concerns if NATO did get involved in the current hostilities. So we actually have 3 triggers. Again, we don't think any of them will be activated. And again, we continue to be in a position where we are trying to just control a bit of volatility, not really being negative. I look back, and this is an anniversary of sorts. We started recording these sessions 9 years ago, second quarter of 2013. And I mention that because you're all welcome to go out and see what we were talking about previous quarters. And we're happy to have you do that. And I think this has really been a good thing where we're being able to share with you. So please tune in next quarter, and until next quarter, goodbye.